Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today we're diving into a concerning topic for many Canadians. The Canada Mortgage and Housing Corporation, or CMHC, has reported a rise in the mortgage delinquency rate to 0.22% in the second quarter of 2025. While historically low, this increase signals a shift from the lowest rate in years, which was 0.14% in 2022.
That's right, Sandy. The CMHC is keeping a close watch on this situation. Aled Abiorworth, the deputy chief economist at CMHC, mentioned in a recent interview that he expects this trend to continue upward, given the economic pressures we're facing.
Yes, and it's not just about the numbers. Many Canadians are feeling the pinch as they renew their mortgages at higher interest rates. With 2 million mortgages coming up for renewal this year, and in 2026, a significant number of homeowners will be affected.
The interest rates for homes and condos are expected to be 3 percentage points higher than they were 5 years ago. This is a big jump for many households, especially those who bought during the pandemic when interest rates were exceptionally low.
And it's particularly challenging for condo owners in Toronto who bought in at those low rates. Now, with higher unemployment rates in the city, they're facing even more pressure.
Indeed, Toronto seems to be a hotspot for these challenges. But it's not just Toronto. Other major cities like Vancouver and Montreal are also feeling the heat, though to a lesser extent.
Exactly, Steve. The impact of the US-Canada trade war and the overall economic slowdown are compounding these issues. Developers are hesitant to start new projects, which could exacerbate the housing shortage and drive prices up in the future.
That's a good point, Sandy. While the situation is concerning, Maria Solovieva from TD Bank pointed out that the system isn't likely to experience a shock. She noted that total mortgage payments are actually declining due to some lower mortgage rates available.
It's a mixed picture, isn't it? While some are struggling, others are finding some relief. But as Shale Weinreb from the Home Equity Partners highlighted, the cost of living is pushing many to rely on credit, which isn't sustainable in the long run.
Right, it's a balancing act for many Canadians. Alberta, for instance, seems to have a stronger economy and might be better positioned to handle these delinquencies than Ontario.
Absolutely, Steve. It's a complex issue with no easy solutions, but understanding these dynamics is crucial for anyone involved in the Canadian housing market. Today, we're going to talk about something that's caught the attention of everyone in the financial sector, a recent speech by the Bank of Canada that has been described as one of the most disturbing in a generation. The central bank is considering a major overhaul of how it measures inflation, and this has some serious implications for the housing market.
That's right, Sandy. Deputy Governor Rhys Mendez from the Bank of Canada highlighted that mortgage costs have been distorting the Consumer Price Index, or CPI, which is their preferred measure of inflation. They're now considering whether to exclude mortgage interest from their calculations to better reflect underlying inflation.
It's interesting, Steve, because this potential change could really shake things up. The Bank of Canada has its own unique approach to measuring inflation, and including mortgage interest in the CPI has given it a disproportionate influence over inflation. This has created a sort of circular logic where mortgage rates drive inflation and inflation drives mortgage rates.
Exactly, Sandy. This circular logic has meant that the Bank of Canada can see immediate effects from its rate changes. If they cut rates, mortgage costs fall, which then drags the CPI lower, justifying more rate cuts. But on the flip side, if they raise rates, mortgage costs surge and push the CPI higher, creating pressure to cut again.
And that's been a challenge for Canadian households, especially during this real estate boom-bust cycle. The Bank of Canada's approach has been under scrutiny, because it seems to create excessive pain for households, as large portions of inflation remain uncaptured when mortgage interest is included.
Deputy Governor Mendez acknowledged this issue, stating that mortgage interest costs obscure the broader response of inflation, leading to poorly guided policy decisions. The bank is now rethinking whether to revise its core measures of inflation to exclude mortgage interest costs.
It's a step towards more accurate inflation measurement, but as Mendez pointed out, it's not just about numbers, it's about understanding the broader economic fundamentals. He described underlying inflation as more of a concept than a statistic, trying to capture the lasting part of inflation related to economic fundamentals.
It's a bit perplexing, though, because even as they talk about underlying inflation as a concept, Mendez used it as a statistic to justify recent rate decisions. This has raised questions about the effectiveness of the Bank of Canada's current approach.
It's definitely a complex issue, Steve. While the Bank of Canada is considering changes, some believe it's time for a significant shift in how inflation is measured and managed, particularly given the pressures on Canadian households and the housing market.
The debate continues, Sandy. As the Bank of Canada explores these potential changes, it'll be crucial for policymakers to balance the need for accurate inflation measures with the realities faced by Canadian households. We'll have to wait and see how this unfolds.
Recent data from the Toronto Regional Real Estate Board suggests that the housing market in Toronto is showing signs of activity, but a deeper look reveals a more complex picture. Sales have increased by 8.5% compared to last year, and the Bank of Canada's recent rate cut has improved affordability slightly. However, prices remain under pressure, listings are accumulating, and properties are taking longer to sell.
That's right, Sandy. While it might seem like the market is picking up, the reality is that it's still structurally imbalanced. The average sale price in September was $1.06 million, which is down 4.7% from the previous year. The home price index also fell by 5.5%. This suggests that while sales are up, the value of these sales is not keeping pace.
And it's not just about the numbers. The increase in active listings by nearly 19% compared to last year shows that more homes are sitting on the market. This has pushed the total inventory to almost 30,000 homes. Homes are also taking longer to sell, with the average listing period increasing from 27 to 33 days.
Exactly, Sandy. As Daniel Foch highlighted in his analysis, no serious discussion about the market bottoming out can occur while supply continues to rise faster than demand. The imbalance between supply and demand is a critical factor that needs to be addressed before we can talk about any real recovery in the market.
The market's unevenness is also evident when you break it down by home type. Detached home sales rose by 9.6%, but average prices still fell by 5.1%. Semi-detached homes and condominiums saw similar trends. However, townhouses in the city showed a nearly 40% increase in sales, indicating a strong buyer preference for more affordable, ground-oriented homes.
That's an interesting point, Sandy. The demand for townhouses in Toronto suggests there's an appetite for what some call the missing middle housing. Options that are more affordable than detached homes, but offer more space than condos. This highlights the need for a balanced supply that meets diverse housing preferences and budgets.
Absolutely, Steve. And while central locations are showing some resilience, suburban markets are facing steeper adjustments. Detached home prices in suburban areas fell by 7.2% compared to less than 1% in the city. This divergence further underscores the unevenness in the market.
All of this is happening against a challenging economic backdrop. With GDP contraction and a rise in unemployment, even with inflation cooling to 1.7%, households are cautious. While lower rates can stimulate spending, Daniel Foch argues that relying on monetary easing alone isn't a sustainable solution for the market's structural issues.
The path forward seems to hinge on whether demand can sustainably absorb the surge of listings. Additional rate cuts might add some momentum, but they can't correct the oversupply or rebuild seller confidence on their own. It's clear that policymakers and builders need to address the alignment of new supply with true affordability.
For now, Buyers have a rare period of leverage with abundant choice and extended timelines. Sellers are adjusting their expectations downward. But until supply and demand converge, any recovery in Toronto's housing market will be more appearance than reality, as Fauch pointed out.
Let's dive into the latest shifts in Canada's housing market. September brought a mix of opportunities and challenges for mortgage professionals and their clients across the country. Rising inventories and shifting buyer sentiment have defined the landscape, presenting a complex national picture.
That's right, Sandy. It's interesting to see how different regions are reacting. In Calgary, for instance, the market is tipping towards buyers, with a significant 14% drop in sales and a 36% increase in inventory compared to last year. Anne-Marie Lurie from the Calgary Real Estate Board noted that the supply levels are rising across resale, new home, and rental markets.
And these changes are happening amid slower population growth and persistent economic uncertainty. Calgary's months of supply reached 4.02, the highest since early 2020, marking a clear shift from the seller's market we've seen in recent years. The apartment sector in particular is experiencing a correction with prices down over 6% and inventory swelling.
Yes, the CREB report highlighted that this adjustment is largely due to improving rental supply and delayed interest rate adjustments, which have slowed demand from first-time buyers and investors. It's a significant shift for Calgary's housing market.
Meanwhile, Montreal and Quebec City are bucking the trend with a sales surge. Montreal's residential market saw an 11% jump in sales, which is well above the 25-year average for September. Median prices for single-family homes and condos are climbing, indicating strong buyer interest.
That's a stark contrast to Calgary, Sandy. In Quebec City, single-family home prices rose 13% and condos went up 16%. The increase in new and active listings in Montreal suggests that sellers are gaining confidence and returning to the market.
Over in Vancouver and Toronto, buyers are gaining leverage as prices ease. Metro Vancouver saw a modest uptick in sales, but activity remains below the 10-year average. Inventory rose significantly, and the composite benchmark price fell 3.2% year over year.
Andrew Liss from GVR noted that easing prices and high inventory levels are creating opportunities for buyers. It's a similar story in the Greater Toronto Area, where sales climbed 8.5% following the Bank of Canada's rate cut. However, the average selling price slipped nearly 5%.
It's a dynamic situation, Steve. The interplay between interest rates, supply, and affordability continues to shape Canada's housing market. While some regions are seeing renewed activity, others are grappling with challenges. It'll be interesting to see how these trends develop in the coming months. Equifax Canada has released its latest findings on mortgage fraud, revealing that while overall fraud rates have decreased, the sophistication of fraudulent activities is on the rise. According to their third quarter fraud trends report, mortgage fraud rates have slipped by about 10 basis points year over year to 0.19% of applications. This decline coincides with a slowdown in housing demand and fewer submissions, but the remaining fraud cases are becoming increasingly complex.
That's an interesting development, Sandy. Cheryl Prince, the director of fraud consulting at Equifax, emphasized that despite the reduction in overall mortgage fraud activity, lenders need to remain vigilant, especially when it comes to verifying financial documents. This is crucial because financial misrepresentation continues to dominate the fraud landscape, accounting for more than 3/4 of detected cases.
Yes, Steve, and the report highlights that falsified income and fabricated documents are at the core of these fraud cases. Employment letters, pay stubs, bank statements, tax slips, and down payment verification materials are the most commonly manipulated documents. It's a reminder that even as the numbers decrease, the threat remains significant, particularly in Ontario, Alberta, and Quebec, which have the highest levels of mortgage fraud.
That's right, Sandy. Interestingly, British Columbia has seen some improvement after previously ranking among the top provinces for fraudulent activity. Equifax attributes this decline to lower overall activity in housing markets, which has resulted in fewer fraudulent submissions. However, they caution that this might be a temporary lull, as fraudsters are likely adapting their strategies rather than stepping back.
It's a concerning trend, Steve. The data also shows that mortgage fraud is becoming more concentrated among certain borrower groups, such as first-time homebuyers and non-mortgage holders. These groups are more likely to engage in income and document misrepresentation, possibly due to the mounting affordability pressures they face. It's a tricky situation for lenders to navigate.
Absolutely, Sandy. The report also mentions the evolution of broader fraud ecosystems, including synthetic identity fraud and true identity fraud, which are increasingly targeting those with higher credit scores. The use of artificial intelligence tools to scale identity fraud attacks is a growing concern, especially as lenders rely more on digital verification processes.
It's clear that while the number of fraud cases might be declining, the risk isn't necessarily reduced. Equifax's Cheryl Prince stresses the importance of strong document verification processes to ensure that safeguards are not relaxed as volumes decline. It's a critical time for lenders to tighten their verification measures and remain cautious.
Indeed, Sandy. With first-party fraud reaching its highest level since 2021, even as third-party fraud shows a slight decline, it's evident that the landscape of fraud is shifting. Payment-related scams, like deposit and bust-out fraud, are also on the rise, particularly in the banking and telecom sectors. Lenders need to adapt to these changes and prioritize robust fraud detection strategies.
Let's talk about the rise of prefabricated homes in Canada. These homes, built in factories and then transported to their final location, are becoming increasingly popular. They're known for their modern features, energy efficiency, and the ability to skip lengthy construction delays. However, the mortgage process for these homes can be a bit more complex than traditional builds.
That's right, Sandy. Prefabricated homes come in three main types: mobile homes, manufactured homes, and modular homes. Each of these has different implications for financing. For instance, if your prefab home is on land you own, you might qualify for a traditional mortgage. But if it's on leased land, like in a mobile home park, you may need what's called a chattel loan.
Exactly, Steve. A chattel loan treats the home as personal property, similar to an auto loan, which often means higher interest rates and shorter terms. This can be a challenge for potential buyers who are looking for more affordable options.
And it's not just about the type of loan. Whether a prefabricated home qualifies for traditional financing often depends on specific conditions, such as the home being installed on site or near completion and having the necessary certifications and appraisals. These requirements can add to the overall cost and complexity.
Absolutely, Steve. The good news is that some lenders, including big banks and credit unions, are becoming more flexible with their offerings for prefab homes, especially those on owned land. But it's important for buyers to do their homework and understand the specific lending criteria they need to meet.
Prefab homes can indeed be more affordable than traditional site-built homes, especially mobile or manufactured models, which can be 10 to 40% cheaper. However, modular homes can sometimes match traditional homes in price, depending on design and finishes. It's crucial to consider all costs, including appraisals and inspections, when evaluating affordability.
Despite their potential benefits, prefab homes still represent a small portion of the Canadian housing market, with only about 1% of Canadians living in them. However, with federal incentives and grants, this niche market is expected to grow. But challenges like zoning and community restrictions remain hurdles for widespread adoption.
That's an important point, Sandy. For some buyers, the appeal of prefab homes lies in their quick setup and energy-efficient design. For others, it's the flexibility of location. But as we've discussed, the mortgage side of things requires careful consideration, and prospective buyers should be ready to navigate these complexities.
The ongoing trade war between the United States and Canada continues to cast a shadow over the housing market, but the mortgage industry is taking proactive steps to support clients during these uncertain times. Prime Minister Mark Carney's upcoming visit to the White House has many wondering if there will be any progress in negotiations, but expectations remain low.
That's right, Sandy. The trade war has created significant challenges, with tariffs on Canadian goods like steel, aluminum, and lumber, as well as a new 25% charge on medium and heavy duty trucks entering the United States. These measures have rattled homebuyers, pushing many to hold off on purchasing decisions as they wait to see how the situation unfolds.
Despite these challenges, there are signs of hope, particularly with the Bank of Canada's recent rate cuts. Rasha Ingrata, a mortgage agent with Shop Mortgages in Windsor, Ontario, noted that these cuts have helped ease some of the payment pressures for borrowers facing mortgage renewals. She mentioned that consumer confidence is gradually returning, with rates not as high as they were a year ago.
That's encouraging, Sandy. However, the economic strain from the tariffs is still palpable, especially in areas like Windsor, which is heavily reliant on the auto industry. Job losses, reduced hours, and overtime cuts are impacting borrowers' income, making it challenging to qualify for mortgages. Ingrata highlighted the difficulty of using two-year income averages when current earnings don't align with past figures.
It's a tough situation, Steve, but Ingrata emphasizes the importance of focusing on what the mortgage industry can control. Her approach involves ensuring clarity and quality in client interactions, educating borrowers on different products and processes, and providing ongoing support even after the mortgage closes.
Indeed, Sandy. As the trade war continues, the mortgage industry is doubling down on client support, ensuring that borrowers are well informed and confident in their decisions. This proactive approach is crucial as we wait for a resolution to the tariff dispute. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.